Starting Monday, you'll be training Jessica Chen to take over your accounting responsibilities. That's what Richard Morrison, our CFO, announced during our one-on-one meeting on a Friday afternoon in April 2024, delivering the news with the clinical detachment of someone who decided that replacing a senior accountant with someone half the salary was smart financial management regardless of the humiliation involved. Training your replacement. I'd been senior financial accountant at Quantum Logistics for 9 years, managing revenue recognition, expense accounting, and financial reporting for a mid-sized freight company with $218 million in annual revenue, ensuring every transaction was properly recorded and every financial statement accurately reflected business operations according to GAAP standards. But according to Richard, our CFO who'd joined Quantum 15 months earlier from a private equity firm where he'd specialized in cost optimization, my $98,000 salary was excessive for work that someone with 3 years of experience could handle for $55,000. And he'd decided that forcing me to train my cheaper replacement was an efficient way to transfer knowledge while demonstrating that nobody was safe from his cost-cutting initiatives. I'm Lauren Mitchell, and I sat in Richard's office listening to him explain how I'd spend the next month teaching Jessica everything about my job before being transitioned out with a severance package, while knowing exactly which accounting irregularities I'd been reporting to Richard for 9 months and exactly what would happen when someone new looked at Quantum's books without the context of knowing which issues had already been escalated and ignored. 9 years, 2 months, and 17 days of maintaining accurate financial records, raising concerns about revenue recognition problems, and trying to prevent the kind of accounting fraud that destroys companies, and Richard had decided that my institutional knowledge was replaceable by someone fresh out of college who'd work for $43,000 less annually. I wasn't the CFO who made strategic decisions or the controller who prepared consolidated statements. I drove a 2018 Honda Civic with 94,000 miles on it and accounting textbooks in my back seat because I reviewed complex revenue recognition standards during lunch breaks to stay current with evolving GAAP requirements. I lived in a modest apartment in Charlotte with a home office containing files documenting every accounting concern I'd raised over the years, emails to Richard about questionable revenue transactions, memos about expense classification issues, and detailed analysis of financial statement adjustments that didn't follow proper accounting principles. I was meticulous about transaction documentation, protective of financial accuracy, cautious about anything that might constitute earnings manipulation, and apparently replaceable by someone who'd accept lower pay and presumably fewer questions about the CFO's accounting decisions. The trouble had started 15 months earlier when Quantum Logistics had hired Richard Morrison as CFO to improve financial performance and prepare for potential sale to strategic acquirers. Quantum's private equity owners wanted to exit their investment with strong returns, which meant maximizing EBITDA and making financial results look as attractive as possible to potential buyers. Richard came from a private equity operations background where he'd worked to make portfolio companies' financials look optimal for exit transactions. He had that aggressive financial engineering mindset, talking about maximizing reported earnings, optimizing accounting elections, and presenting results in the most favorable light. That could mean either sophisticated but legal financial management or could mean crossing lines into accounting fraud depending on how it was implemented. Over his first year at Quantum, Richard had made numerous accounting decisions that concerned me. In July 2023, he'd instructed me to recognize revenue from a major contract immediately upon signing rather than over the service delivery period as GAAP required. When I'd explained that we needed to recognize revenue as services were performed, Richard had said the contract signing demonstrated performance obligations were complete and that immediate recognition was defensible. I documented my objection in an email to Richard explaining that the contract explicitly specified services would be delivered over 18 months and that recognizing all revenue upfront violated the revenue recognition standard. Richard had overruled me, saying his interpretation was reasonable and that I should record the revenue as directed. In September 2023, Richard had told me to capitalize certain software development costs that should have been expensed. Capitalizing costs rather than expensing them improved current period earnings by moving expenses to the balance sheet as assets. I'd raised concerns that the costs didn't meet capitalization criteria under GAAP. Richard had insisted the costs were qualified and instructed me to capitalize them. In November 2023, Richard had directed me to reclassify certain operating expenses as capital expenditures to improve operating income metrics. Again, I documented my concerns that this reclassification wasn't supportable under GAAP. Again, Richard had overruled me. By February 2024, I documented approximately a dozen instances where Richard had made accounting decisions that I believed violated GAAP standards and potentially constituted fraudulent financial reporting. Each time I'd raised concerns. Each time Richard had dismissed my objections as overly conservative interpretations of accounting standards. In March 2024, I'd escalated to Quantum's external audit firm during their year-end audit fieldwork. I'd mentioned to the audit senior that there were revenue recognition and expense classification issues I'd raised concerns about internally. The auditor had asked for details. I'd provided examples of the transactions I believed were improperly recorded. The audit firm had raised these issues with Richard. Richard's response had been to characterize my concerns as the objections of an overly cautious accountant who didn't understand business judgment in applying accounting standards. He'd told the auditors that my interpretations were too rigid and that his accounting decisions fell within reasonable application of GAAP principles. The auditors, facing pressure to complete the audit and not wanting to fight with the CFO, had accepted Richard's explanations and issued an unqualified opinion on Quantum's financial statements. But Richard hadn't forgotten that I'd raised concerns with the external auditors. In April 2024, he decided that I was a problem employee who needed to be replaced with someone more cooperative. The decision to hire Jessica Chen and have me train her before being terminated was Richard's way of eliminating someone who questioned his accounting decisions while ensuring operational continuity. Now about 83% of you think I'm about to sabotage Jessica's training or teach her wrong procedures, and you're completely wrong. Subscribe, because what actually happens is that thorough professional training means teaching someone everything about the job, including all the accounting concerns you've raised. And sometimes the person with fresh eyes sees exactly what's wrong and isn't invested in staying quiet about it. On April 29, 2024, Jessica Chen started at Quantum Logistics. She was 25 years old, had graduated from UNC Chapel Hill 3 years earlier with an accounting degree, and had worked at a small accounting firm doing bookkeeping and tax preparation. This was her first corporate accounting role. She was smart, enthusiastic, and completely unprepared for what she was about to discover. Richard's instructions to me were clear: train Jessica on all accounting procedures, system processes, transaction recording methods, and financial close procedures so she could seamlessly take over my responsibilities. I took those instructions literally and professionally. During the first week, I taught Jessica our accounting systems, chart of account structure, and basic transaction processing. During the second week, I walked her through revenue recognition procedures, expense classification policies, and month-end close processes. During the third week, I showed her specific transactions and how I'd recorded them in our accounting system. This is where things got interesting. As a good trainer, I showed Jessica not just what I'd recorded but also the supporting documentation and the accounting standards that governed how transactions should be recorded. When I showed her the major contract from July 2023 where Richard had instructed me to recognize all revenue immediately, I explained the situation thoroughly. This contract was signed in July 2023 for $12.4 million. The contract specifies that we'll provide logistics services over 18 months. Under ASC 606, revenue should be recognized as we perform services over that 18-month period. However, Richard directed me to recognize all revenue immediately in July 2023. I raised concerns that this didn't comply with the revenue recognition standard, but Richard overruled me. You can see here in my email from July 18, 2023, where I documented my objection and explained why I believed the recognition should be spread over the service period. Richard responded that immediate recognition was defensible based on his interpretation. Jessica looked confused. But the contract clearly says services are performed over 18 months. How could immediate recognition be defensible? I showed her the actual ASC 606 standard. It's not defensible under the standard. The performance obligation is clearly satisfied over time as we deliver services. Recognizing everything upfront accelerates revenue that should be recognized in future periods. That's why I objected. But Richard is the CFO and has authority to make accounting policy decisions even when staff accountants disagree. Jessica looked uncomfortable. So we recorded revenue we shouldn't have recognized yet? I nodded. Correct. And because we recognized it in 2023, our 2023 revenue was overstated and our 2024 and 2025 revenue will be understated. The total revenue is the same over the contract life, but the timing is wrong. This is called improper revenue recognition, and if it's done intentionally to manipulate reported earnings, it can constitute fraudulent financial reporting. I showed Jessica 8 other transactions where similar issues existed, expenses that should have been recorded immediately but were capitalized to improve earnings, operating expenses reclassified as capital expenditures to improve operating metrics, and costs that should have been recognized in earlier periods but were deferred to future periods. For each transaction, I showed her the supporting documentation, explained the proper accounting treatment under GAAP, showed her the actual accounting Richard had directed, and provided copies of my emails documenting my objections. Jessica asked the obvious question, "Lauren, if you raised all these concerns and they were overruled, why are you showing me this? Shouldn't I just follow whatever Richard decides the accounting should be?" I responded carefully, "Jessica, my job is to train you thoroughly on everything about this role. That includes showing you the transactions we've recorded, the accounting standards that apply, and the concerns I've raised. What you do with that information is up to you. But as an accountant, your professional responsibility is to ensure financial statements are fairly presented under GAAP. If you believe something is recorded improperly, you have a duty to raise concerns. Whether those concerns are acted on is someone else's decision, but you need to understand what proper accounting looks like versus what we've actually recorded." By the end of the 3rd week, Jessica had a comprehensive understanding of Quantum's accounting processes and also a troubling understanding of the accounting irregularities I'd been documenting. During the 4th week, I showed her how to prepare financial statements, how to interact with external auditors, and how to handle month-end close under time pressure. On May 24, 2024, my last day at Quantum, I completed Jessica's training and provided her with organized documentation of all major transactions, accounting policies, and system processes. I also provided her with copies of all my emails to Richard documenting accounting concerns I'd raised. I told her directly, "Jessica, these emails show accounting issues I raised with Richard over the past year. I'm giving you these because if the same issues continue or new similar issues arise, you'll need to understand the history and you'll need to make your own professional judgment about whether to raise concerns. I hope you won't face these situations, but if you do, remember that accountants have professional responsibilities that go beyond following orders." I left Quantum on May 24. Richard seemed satisfied that the transition had gone smoothly and that he now had a more affordable and presumably more compliant accountant in my place. What Richard didn't anticipate was that Jessica Chen was a recently qualified CPA who'd passed her exam just 6 months earlier and took professional ethics seriously. She'd seen enough during training to be deeply concerned about Quantum's accounting, and unlike me, someone with 9 years of institutional history and complicated relationships with management, she had no loyalty to Richard and no hesitation about doing what she believed was professionally required. On June 7, 2024, 2 weeks after I left, Jessica sent an email to Richard Morrison and Quantum's controller raising concerns about multiple accounting transactions she believed didn't comply with GAAP standards. Her email cited specific contracts, specific expenses, and specific accounting standards being violated. She requested a meeting to discuss proper accounting treatment. Richard responded dismissively, characterizing Jessica's concerns as misunderstanding of complex accounting judgments. Jessica sent a follow-up email stating that she couldn't, as a CPA, participate in preparing financial statements she believed were materially misstated. She requested that Richard either correct the accounting or provide written documentation of his position that she could review with her own professional advisors. Richard called Jessica into his office and reportedly told her that she needed to trust his judgment as CFO and that junior accountants don't question senior management's accounting decisions. Jessica responded that her CPA license required her to ensure financial statements were fairly presented and that she had professional obligations regardless of her seniority level. On June 14, 2024, Jessica resigned from Quantum Logistics. In her resignation letter, she stated that she couldn't continue in a role where she was being asked to participate in financial reporting that she believed violated GAAP standards. She also filed a complaint with Quantum's external audit firm detailing the accounting concerns she'd identified during her brief tenure. The audit firm, which had just issued an unqualified opinion on Quantum's 2023 financial statements, now faced a whistleblower complaint from a CPA who'd identified specific GAAP violations in the exact financial statements they'd audited. This triggered an internal review at the audit firm to determine whether they'd missed material misstatements during their audit. By July 2024, the audit firm had informed Quantum's board that they were investigating potential accounting irregularities and that depending on findings, they might need to withdraw their opinion on the 2023 financial statements. A withdrawn audit opinion would be catastrophic for Quantum. It would signal to potential acquirers that the financial statements couldn't be relied upon and would effectively kill any sale transaction. The board launched an independent investigation led by an outside law firm and forensic accounting firm. They interviewed me, Jessica, Richard, and multiple other employees. They reviewed the emails I'd sent documenting accounting concerns. They examined the transactions Jessica had identified in her resignation letter and audit firm complaint. In September 2024, the independent investigation concluded that Quantum Logistics had materially misstated its financial statements through improper revenue recognition, inappropriate expense capitalization, and incorrect classification of operating expenses. The misstatements had overstated earnings by approximately $8.3 million over 18 months. The investigation found that these misstatements resulted from accounting decisions made by CFO Richard Morrison over objections from staff accountants who had properly raised concerns. The investigation recommended that Quantum restate its financial statements, strengthen accounting controls, and terminate Richard Morrison for causing material misstatements in financial reporting. On September 19, 2024, Quantum's board terminated Richard as CFO. On September 26, Quantum announced it would restate financial statements for 2023 and Q1 2024 to correct accounting errors. The restatement reduced reported revenue by $9.4 million and reduced reported operating income by $8.3 million. The restatement killed Quantum's pending sale process. Potential acquirers walked away from a company whose financial statements had been materially wrong and whose CFO had been terminated for accounting fraud. Quantum's private equity owners were stuck with an investment they'd wanted to exit, now worth significantly less due to the accounting scandal. On October 3, the board offered me my job back as senior financial accountant with an immediate salary increase to $115,000, recognizing that my documented objections to Richard's accounting had been correct all along. They also asked if I'd be willing to serve as interim controller while they searched for new financial leadership. I accepted the controller role with appropriate compensation. Over the next 3 months, I worked with the new external audit firm to complete restated financial statements and implement proper accounting controls. In December 2024, I ran into Richard at an accounting industry conference. He was working as a financial consultant, trying to find CFO roles after being terminated from Quantum. "Lauren, I heard you're back at Quantum as controller. That worked out well for you." I looked at him directly. "I'm back because I spent 9 years documenting proper accounting procedures and raising concerns when you directed me to violate GAAP standards. You replaced me with someone cheaper thinking she'd be more compliant. Instead, you got a recently qualified CPA who looked at the exact same transactions I'd been objecting to, reached the exact same conclusions about GAAP violations, and had the professional integrity to resign and report to auditors rather than participate in fraudulent financial reporting." Richard tried to defend himself. Those were judgment calls about complex accounting standards. Different professionals can reasonably disagree. I responded, "Richard, there was nothing complex about an 18-month service contract that clearly required revenue recognition over time. There was nothing complex about operating expenses that you reclassified as capital expenditures to manipulate operating income. Those weren't judgment calls, those were intentional misstatements to make Quantum's financials look better for sale. I documented objections to all of them. Jessica identified all of them during her training. 2 CPAs independently concluded your accounting was wrong. That's not reasonable disagreement, that's fraud that 2 accountants refused to participate in." Richard walked away. The lesson here isn't subtle. When you force someone to train their replacement, you're betting that the replacement will be more compliant than the person you're removing. Sometimes that bet fails spectacularly because the replacement turns out to have principles, professional ethics, and fresh eyes that see exactly what's wrong without the institutional baggage of having learned to tolerate it. I trained Jessica Chen properly and professionally. I showed her every transaction, every accounting standard, every documented concern I'd raised. I didn't need to teach her to commit fraud, I just taught her accounting. She did the rest herself because she was a CPA who understood her professional obligations. Richard thought getting rid of me would eliminate his accounting problems. What it actually did was bring in someone with no loyalty to him, no reason to stay quiet, and every reason to protect her CPA license by refusing to participate in improper accounting. That's not sabotage, that's professional ethics meeting financial fraud. And professional ethics 1. You want to replace your experienced people with cheaper versions? Do it. But understand that sometimes the person you bring in has fresher eyes and stronger principles than the person you forced out. Sometimes they see exactly what's wrong and have less patience for staying quiet about it. And sometimes the thing you thought you were saving money on ends up costing you everything. Comment if you've ever trained your replacement and wondered what they'd do with everything you taught them. Subscribe if you believe accounting fraud should be called out regardless of who's committing it. And remember, thorough training means teaching everything, including the parts that should make people uncomfortable.